Which is the ideal investor for you? So which are the ones you want to work with and which are the ones you just don't want to deal with? Okay, so the 8 personality types. The first one, well, it's the risk taker. And what does the risk taker say? Well, high risk, high reward. That's how you make real money. I'm going in on this new crypto. It's going to be the next Bitcoin. Anybody in the audience like this? I'm like this for like 5% of my portfolio, just so you guys know. Like 5% of my portfolio, I'm like, snake eyes. Let's go. Let's see what happens. If anybody wants to know how to make $500 in crypto, here's the secret. Start with 1,000. That's what I did recently. Worked out really well for me. Again, I bought it on Wealthsimple as bullshit. I didn't care. But my point is that you have the risk taker. Some people are risk 100%, all in all the time. In your mind, pay attention to the signs. The second type is the conservative. They'll say things like this: why gamble when you can invest in bonds, right? That's a different debate about whether those are safe or not, but mentality is mentality. I prefer slow and steady growth. It's all about preserving capital. By the way, the whole preserving capital thing is actually a really good idea, So I tell you right now, in private equity, one of the most profound lessons I ever learned, I had a managing partner pull me aside because I looked at a deal. I'm like, hey, this is a no-brainer. He looks at me, he goes, kid, I'm going to say this to you once. I go, what's that? He goes, I don't care about return on capital till I know what the return of capital looks like. So in other words, show me how I get my money back, when I get my money back, and then I'll determine if what you're going to pay me for the return after the fact is worth the risk. There's the super conservative investors, the analyst, the engineers in the room, the accountants. I've read the last 5 years of annual reports. Let's dive into the technicals before making a move, all right? By the way, with a lot of you in this room, you need a partner as an analyst, just so you know, okay? Before you actually raise money for your deals, you better be the analyst or you better have somebody like this on your team, because you can't just have unbridled enthusiasm. But you're going to identify this in your potential investors. You're going to have a different conversation with this investor than you will with somebody who's just saying, okay, this could be the next Bitcoin. That's where you guys need to understand financial statements, underwriting, have a partner that understands that kind of stuff, because those investors that write typically 6, 7, 8-figure checks, they got people like this around them. They really do. The next one is the trend follower. So they'll say something like, everyone's buying Uber, or this company's going public, or look at all these cars, look at all this stuff that's happening. It's a no-brainer. Tesla, look at all the Teslas. They're trends. They're following trends. A few years ago, the big kick with the grocery stores was quinoa. Quinoa became the new thing. So all of a sudden, they created quinoa burgers at McDonald's and all this crap, and the meatless burgers. Remember that stuff? Those are trends, right? So people invest in trends. There's certain people that invest in trends. That's their thing. They follow trends. That's what they invest in. Bitcoin. That was another one. Contrarian. You guys have all this stuff in your book, by the way. Contrarian is the person that's convinced that the market's got it wrong. Who are my gold bugs in the room? Anybody like gold? I have a lot of gold, but gold bugs, right? Contrarian. The economy's going to shit. They don't know it yet. Blah, 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 blah. You got to put everything into guns and gold and gas. And you just got to be aware of this. I'm not saying any of these are right or wrong. Just be aware of the type of people you're talking to. The next one is the diversifier. Their answer to everything is to diversify. Everything. You just diversify everything. I have a lot of my buddies, a lot of really smart, intelligent people subscribe to this because in the absence of knowing anything else, they just spread everything out everywhere and hope for the best. And then finally, the emotional investor. These are the ones that you really have to pay attention to, okay? I do not like emotional investors because as soon as they read something in the paper about real estate going down, 3-hour phone call. I don't like emotional investors personally. Also, emotional investors are the ones that want to buy and sell all the time. If you're doing private closed funds, these are not the people you want to attract to your investments. So part of the thing we teach is, how do you assess? One of the best questions to ask an investor is, how do you assess risk? How do you look at opportunities when markets change? There's a whole bunch of questions that we teach you guys to ask people in the meetings to get things flushed out, to figure out who it is that you're sitting with. Pardon me, the last one is truly the passive investor. And they're the ones that say things like, why do it yourself when you can hire experts? Perfect. The question is, which one are you? Best way to identify other people is to be clear about yourself, right? Now, most of you have shades of 2 of these, maybe 3 of these, but there is one predominant driver. And finally, depending on what you're doing, which is the ideal investor for you? So which are the ones you want to work with and which are the ones you just don't want to deal with? This seems obvious as I say it now, guys, but trust me, if you look at the next step through this filter, this will make it a lot simpler for you to say yay or nay to potential people that you're thinking of working with. Because it depends on the type of business that you're building. Because if you're in a tech business or a startup business, you want the, trend followers. You want the risk takers. You don't want the analysts on your team because, well, you might want them on your team, but you don't want them as an investor because there's nothing to analyze, man. It's a new app. Like, yeah, we're going to figure out how to deliver, I don't know, bacon to the moon. I don't know what the app's going to do, whatever. Like it's, you just figure it out, right? You figure out what you're doing. Whereas real estate, there's a different investor. There's a different fit for that. It's really important that you guys start to become aware of these things and really consciously think about who those ideal investors are for you. So, building your list. Now, at this point, just think about the stage of the game you're at and in the cycle. You haven't launched your fund. You haven't created the right offer yet. So try not to bias yourself in the context of who is a potential investor and who isn't. Don't apply your biases yet because you're immediately going to be sitting there like, oh, that guy would never, don't do this yet. Just do yourself a favor. And if you really work this isn't going to happen today. I mean, if people jump out immediately, great, write it down. But over maybe even this evening or over the course of the next week, work your way through the list that's within your workbook and think about it in the context of two ways. One, people that have had interactions with you in the context of the stuff that's here. So for example, people that see you as an authority, people that work in the industry, people that are involved with XYZ relative to where you're at, people that are going to potentially benefit from the project after the fact, like your development. For example, if you have carpenters that you're going to be hiring, tradespeople, architects. I did a deal with Brad Lamb here in Toronto to fund some of his condos way back when. And one of the things I learned from Brad, so obvious but so brilliant, anybody that bids on his projects has to buy a condo. So if you're bidding on his deal to get $1 million contract to put glass or to do anything within the building, you're buying a condo. It's part of the deal. So if you're not prepared to buy a condo, don't even submit a bid. Now, you could call that insider trading on the stock market, but in private equity, that's just good business. That's just good. That's just smart. He doesn't have to pay a commission on that. There's all kinds of tax things I'm sure that they can maneuver and figure out. But the point is, what's he doing? He's re-engaging his entire ecosystem throughout the entire transaction. These are $1 million contracts, $500,000. That's another beautiful thing about building a fund, guys. You're not pissing around with a duplex and replacing windows for $500. It's the same amount of effort. You get a quote for 500 windows as it is for 1 or 2. One of the deals we did in Tennessee during COVID, there was no windows in Tennessee or the size we needed. There were no windows. We put a guy in a truck and sent him to South Carolina to pick up a couple hundred windows. And we got a discount. And we sold the rest of the windows, and I think we made money on that too. You can't do this with a duplex. That's the power of scale. My whole point is, think about the people that have activities either with you, with what you're doing, what you want to do, or where you're going, and engage them back into the process. They will work with you. They will invest with you. They will bring you people because they want the same outcome you want. This is an easy way to tie it back in. Plus, they understand the project or your goal or your direction. The other way to do it is people's roles, the actual formal roles that they fill. Obviously, CEOs, executives, C-suite people, people that you know that are accountants, lawyers, different people. And by the way, the point is just fill a list. Fill a list of all the humans, your network, your database, all the people, Mel, that you've served over 30 plus years. You guys all have goodwill with people that you've served. And it doesn't matter that you don't know how to approach them with this yet. Just think about who those people are. Step 3 is complete what I call a relationship audit. So look at those relationships and don't do step 3 until you're done 1 and 2, because your biases will start coming into play. Step 3 is you look at those individuals, and simplest way to do this is to just take an Excel or a Google sheet, name, last name, and then relationship audit, have 3 more cells. One for the quality of the relationship, the level of influence you perceive that they have, and the level of wealth that you think they have. Keywords, you think. It doesn't mean that you've seen their financials or their bank account. It's, in other words, relationship. Okay, so Bishot and I, we just met. So our relationship is a 3 because we don't know each other yet, right? Whereas Mel and I, we've known each other for a couple of years. So let's say he and I are a 1. So on the list, he'd be a 1. Because we have a very, very good relationship. We're in regular communication, and there's a lot of affinity there. We just met. It's a 3. It doesn't mean that we wouldn't work together, but we just don't know each other yet. So that's the first piece. Second piece is influence. So I don't know you. I don't know what level of influence you have within your community. I know Mel, I'd say what level of influence he has. So some of them will be blank for some of you guys for the time being. That's okay, but at least start to fill it in. And 3, let's just say I don't know you, but you drive a Rolls Royce. So, okay, well, wealth, I perceive him to be a 1. Now, I don't know if you can afford the roles, if it's your dad's roles, whoever it is, but it's my perception. It's a starting filter. So once you guys work your way through your entire list, your level of your relationship audit, you can then step back and look at the 100 or 500 people you have on your list and actually have a sober perspective of where you stand with your network. It doesn't mean it's a complete blueprint of everything, but it's one of those, you got a pretty good indication of who's out there. What it'll also do is it'll expose entire networks that you never really thought of. And then step 4, this goes kind of beyond the training here, but then create an automated outreach plan to that audience. Create an automated outreach, because you're not going to have the time. You will call maybe a dozen or a couple dozen of those people, but you're not going to call all 500. So how do you create an automated way to consistently reach out, figure out who's interested, and then continue to deliver value to those people that are interested? So starting point for that is your target outreach. Let's assume you're sitting there and you don't have an opportunity on the books. You don't have a deal. How do you start the conversation? Well, this is a good start. Hi, John. Wanted to reach out to you about some of the real estate opportunities that I've been working on. I've been coming across more and more private opportunities, but it's starting to become more than I can handle on my own, and I'm looking for a few more investors to work with. Obviously, you'll need more information, but would you consider something like this if it made sense? Who would be offended getting something like this? If you have anybody that gives you shit for getting this, you need new friends. This is not offensive in the least. Think about the one line in there. Obviously, you're going to need more information. Well, yeah, obviously, you're going to need more information, but you're stating the obvious. It's a soft way, and you're going to get 3 types of responses. No response, positive response, or a negative response. By the way, negative responses are usually less than 5%. Really negative, I just mean no. No thanks. The positive responses far outweigh it. Far, far, far outweigh it. People will be like, oh my God, I didn't know you did that. I didn't know you actually worked with investors. I'm interested. Or, you know what? I don't have any money right now. Now, if you're sitting there and you have a deal, great. Same thing. Except replace the fact that, rather than I'm working on a few things, I've got this one great thing that I'm working on. I thought of you. I'd love to tell you more about it. Would you be interested? Obviously, you're going to need more information. It's a really easy way to do this. The second one eliminates the excuse. Because when I used to teach this, I would only do it with the first one. And then people would say, well, I don't have a deal. You don't need a deal to start a conversation. I can tell you, even on the institutional side, deals aren't even packaged, and you can speak to this. Deals aren't even packaged, and they're out there getting what's called soft commitments on the concept, on the theory, on the investment thesis of X, Y, Z coming together. Would you be interested? Yes. What kind of commitment would you look at? They get back to you and they say, yeah, I'm interested. What do you got? So you get a potential, I'm interested. And then what do most people do? Immediately send them everything. Here's the data, here's the pitch deck, here's the data plan, here's the webinar that's 2.5 hours long. Don't worry, they send you everything. And if the email doesn't bounce because it's over the 20 gigabyte limit or whatever it is, and it actually gets through, as soon as the person on the other side sees that email, they're like, holy shit. Then what do? Close. It's too much. It's just too much stuff. So a softer way to get back to engage the conversation is the X. Hi, so-and-so. Thanks for getting back to me so quickly. I started investing in asset class. Remember the last slides I was sharing with you guys in terms of, this is why it's so important to be specific. I've been investing in asset class. I've been investing in multifamily for, 18 years in the Texas market because I saw real opportunity to buy undervalued properties, refinance them, and build long-term wealth. My team and I are a great fit for this because I've been in the private equity space for over 18 years, and I really understand capital markets, and this is a really good opportunity for us. Personally, I love this asset because, it's a way to build legacy and whatever your personal why is. Kathy's is different than Tom and Kush, than yours, than yours, so on and so forth. And then finally, wanted to share with a few people I can see myself working with. Now, if you have a deal, this property in particular is fantastic because we bought it at a 30% discount. It's right on one of the main roads in Houston, and it's within 1 mile of XYZ. Just 3 bullet points of whatever's compelling about that specific deal. If you don't have a deal, don't include that. And then finally, just ask for a meeting. That's all it is. What does the rest of your week look like for a quick Zoom or meeting in person? I'd love to walk you through it. And then send them your Calendly or your Zoom or whatever it is that you got going on. It's an easy way to start. So, $1 million meetings. There's a lot of parts to the meeting that go above and beyond the conversation here. Look, if you're new to the business, take every meeting for now. because you got to get your ups. Like, you just need to get comfortable having the meeting, telling your story, asking the questions. And it's actually better to practice on people that can't write a check anyway, because ultimately you're actually learning how to go through the motions of the conversation, tell your story. Literally, comedians, before they film a Netflix special, they'll go and they'll travel to the local clubs within a city and then just practice their jokes 10, 20, 30, 50 times before they film their special on stage with the cameras. So as an example, before you actually book the meeting, you can say, hey, just by the way, probably didn't mention this yet, but we're only able to work with accredited investors, and our minimum investment is X. Does that work within how does that fit into your world? There's totally a polite way to say it.